Hello, everyone. We'll get started shortly. We're waiting for a few more participants, but we should start in a few minutes. Okay, I think we'll go ahead and make a start of it. Good afternoon, everyone. Thank you for joining today's El Tamimi and Company webinar on an extremely hot and important topic in the financial services sphere. Of course, that being the transition by banks and financial institutions away from existing interest rate benchmarks to alternative risk-free rates. I see at least some unfamiliar names participating in this webinar today, and that's absolutely wonderful. For those of you who I have not had the pleasure of working with in the past, my name is Omar Handoush, and I'm a partner and head of banking and finance for El Tamimi in the firm's Kuwait office. Broadly, my practice area covers banking and finance, both on a regulatory and transactional perspective, but particularly my area of focus is financial lending transactions, both on the conventional and Sharia compliant side. As many of you know, the transition from interbank offering rates or IBORs to alternative rates over the next year or so represent one of the biggest, if not the biggest, change in the financial services industry ever. Of course, the impetus to this transition away from IBORs to RFRs was the concern beginning at the height of the financial crisis in 2007 that IBORs were being manipulated and that therefore they were no longer accurate and reliable interest rate benchmarks. This subsequently led to a push by market and trade associations and regulators to reform and strengthen the major IBORs. However, in 2017, the Financial Conduct Authority, the FCA, announced that they would no longer compel banks to participate in submitting panels, and accordingly, regulators have urged the transition away from LIBOR. The move away from IBORs to risk-free rates has expectedly proven to be no small task. Market and trade associations, financial institutions, and market participants all have been busy grappling with the move to alternative rates. As you may have seen by the plethora of information out there, there's almost a daily issuance of reports, working group papers, and articles on the way forward with regards to the transition. So keeping up with all of the information is quite a task and has been, frankly, a full-time job for most of us. Some of the issues that are presenting challenges with the transition to risk-free rates center around coordination between working groups. Different approaches to alternative rates can cause operational challenges. RFRs are overnight rates rather than term rates. IBORs incorporate an element of term risk, while RFRs do not include a premium for term funding. RFRs are backward-looking, IBORs are forward-looking that are ascertained at the beginning of an interest period. Thus, the amount of interest is known at the start of the period. Amending template documents has been a challenge given that there's no alternative rate that has gained market acceptance. Amending legacy documents, fallback provisions, and existing documents are generally designed to cater for short-term disruption. Obtaining the requisite consent levels may not be possible to amend the documents. These are but a few of the issues that will be discussed and touched upon by my colleagues today in their respective presentations. So without further ado, as we have a lot to cover today, I'm pleased to introduce two of my El Tamimi colleagues who have been really spearheading the firm's work in this area and who will be handling the lion's share of the presenting today. Sakshi Puri is a senior counsel in our UAE Banking and Finance Group. Her practice primarily focuses on syndicated lending transactions, both on the conventional and Sharia compliant side. Although Sakshi sits in our Dubai office, she is also responsible and leads our banking team in Oman. Sakshi will be leading off the presenting today, and her presentation will largely focus on the lending side of things, and specifically the recommendation and guidance from the Loan Market Association. In particular, her presentation will include a summary of the risk-free rates with a focus on the differences, the current state of play in the transition, the LMA's position on certain issues, LMA's approaches to the documentations and the options available, and the recent approaches taken by certain financial institutions, in particular, the internal calculation of interest rates. In the second half of the presentation, my colleague, Madarima Basu, will be giving her views. Madarima is a senior associate in the firm's banking and finance group who physically sits in the Kuwait office. Although Madarima is well-versed in advising on a broad range of finance transactions, she's a leading practitioner in the region with regard to derivative-related transactions and documentation, both on the conventional side and Islamic equivalent transactions. Madarima's presentation will focus on the transition away from IBORs from a treasury perspective, with particular focus on the ISDA master agreement, covering the fallback protocols for legacy transactions, changes to the definitions for new deals, any collateral documentation protocols, and a brief summary of the state of play with respect to Islamic documentation. Before I turn it over to Sakshi to begin her presentation, just a bit of housekeeping in relation to the format of the presentation. Because there's such a plethora of information, I would ask that you hold questions until the end of the presentation to allow Sakshi and Madarima to give their full presentations. To the extent time permits, we ask that you submit your questions on the link provided in the Zoom platform. There's a Q&A link on the platform at the bottom of the screen. We will attempt to get through all the questions before the end of the hour. Should we not be able to accomplish that, though, rest assured that we will get back to your questions as soon as possible offline. So without further ado, I will hand the rest of the presentation off to my colleague, Sakshi, to begin her presentation.
Good afternoon, everyone. So I'll begin with how the transition of LIBOR has affected the loan markets and the loan documentation. And starting off, we first need to note, and I'm sure many of you are already aware of the alternative rates that are being used already to replace the different LIBORs for different currencies. USD LIBOR has been replaced by SOFR, which is the secured overnight federal rate, funding rate. The GBP has been replaced by SONIA, JPY by TONA, CHF by SARON, Euro by the Euro short-term rate. And there are administrators for all these rates, and these rates have already have been published and are already being used in some of the jurisdictions. Specifically, SONIA is being used quite a bit in the UK. The main difference between the LIBOR and these new rates are that one, LIBOR was a forward-looking rate, whereas these rates, which are the risk-free rates, are backward-looking, and they are based on repo transactions which have been carried out by the banks already. So they're more assertive in deciding on the rate that would be applicable, because they're actually based on actual transactions versus an estimate of what the transactions would be. The second most important difference between the two is there is an element of interest period in the LIBOR rates. And in LIBOR, your interest period, your rate is defined or derived right at the beginning of the interest period. So you know right at the beginning of the interest period what rate would be applicable on the interest payment date. Whereas for the risk-free rates or the RFRs, the rate is derived only a few days before the actual payment of the interest. And they have something called an observation period, which for UK or GBP transactions have been fixed at 5 days. For USD transactions, they haven't fixed the observation period, and there is there's a choice for the lenders to choose the observation period in consultation with the borrower. But typically for USD transactions as well, we've seen that there's a observation period of 5 days that's taken. The third difference that we see is the credit adjustment spread. There is no credit adjustment spread in there is no credit adjustment spread for LIBOR transactions, because there is a rate that everyone's familiar with. But for the RFRs, there's a concept of credit adjustment spreads, because the RFRs, because they're based on actual transactions that have happened, tend to be lesser in terms of the rate than the LIBOR. And in order to prevent one party gaining financial benefit because of the change or the transition in LIBOR, there is a concept of credit adjustment spread that has been given in documents. And so mostly the low interest rate for the RFR loans are based on your margin plus RFRs plus and credit adjustment rate. So these are major differences between the two rates. Now, going ahead, Madhurima. FCA on 5th of March announced what LIBOR settings would cease to exist on 31st of December, which is most of the sterling, Swiss franc, CHY settings. These would cease on the 31st December 2021. However, the US dollar settings, which is what most of us in the region tend to use, which is the one, which is the 3 month, 6 month, 1 month, and 12-month US dollar settings, those would remain till 30th of June 2023. So there is a bit of time when we talk about the US dollar LIBOR loans, because you would have US dollar LIBOR published till 30th of June 2023. Going ahead, in the UK, the aim is that by Q3 of 2021, all new transactions are based on SOFR and do not rely on the existing LIBOR. And any transition documents or any legacy transactions, those also move to SOFR after the end of 2021. Going ahead, so there are different approaches and there are different working groups that have been talking about the LIBOR transition, and I'm sure many of you read different commentaries by different working groups. The major ones obviously are the Alternative Reference Rate Committee, ARC, which has been talking about the transition of the USD LIBOR, and there's LMA, there's the Sterling Reference Group for GBP. In this presentation, we've tried to concentrate on LMA's approach to LIBOR transition, because that's the approach that we tend to look at for all our documentation or documents that we are advising on. So we've stuck to the LMA approach for LIBOR transition. All these approaches, all these working papers provide you the methodology, the calculation, how the transition can be for legacy transactions, what do you do for new transactions. The LMA has 3 fixed approaches. The first one being the rate switch approach. The rate switch, and within the LMA website, they have a microsite for the LIBOR transition. And within that, they already have published all these documents. So you do already have a full-fledged loan agreement with the rate switch approach, the RFR documentation, or the clauses that you need for just putting agreed process for negotiation. All these documents are already published. LMA was using exposure drafts for a very long time when they were getting comments on these drafts, but now they've actually published the actual documents that these are no longer exposure drafts, but are drafts that are recommended by LMA. The first is the rate switch approach, in which the clients, the lender and the borrowers agree on a pre-agreed date, which could either be a date which has been given by the FCA or any other authority, or it could be a pre-agreed date between the two parties on which the rates would switch. So uh, f- for example, you may choose that till 31st of December, the document would be relying on the USD LIBOR for interest rate calculation. And after 30 or after 1st of January, they would rely on the RFR. And you decide on the calculation methodology, you decide on the credit adjustment spread. The credit adjustment spread could either be a percentage, which is fixed, or could be a formula. Again, it is dependent on both the parties, how they want to decide on this. This is an approach where both parties on day one are aware of when the loan would switch, when what would be the rate that would be applicable, and this is more being used by parties who are pretty sure on what they want to be the alternative rate once um, the LIBOR ceases. And we've not seen a lot, but we've seen a couple who've agreed on a rate switch approach on day one, and who've agreed to agreed to move to SOFR after a certain fixed date. Now, any rate switch, you have to keep in mind that any rate switch that happens will happen after the end of any interest period. So you can't have a rate switch within an interest period. One interest period would end and then the second rate would begin. The second documentation that the LMA recommends is the RFR documentation, which is that you decide the risk-free rate applicable for your loan on day one. And from day one, the risk-free rate is what is applicable to your documentation. LIBOR would not be applicable for these documents. And this is an approach which is being preferred by entities who already have the mechanism in place for the calculation of RFRs, who have been using RFRs. These are banks which have already started using RFRs and are far more comfortable. We've seen RFR documentation being used more by loans referring to GBP or the GBP loans rather than USD loans, because like I said, there's still a lot of time for USD transition, most of the USD setting transition. Then the third bit that is there is that you either don't agree on a rate switch or not agree on an RFR document, but you actually agree on the mechanism on day one on how you would negotiate the documents or how you would agree on a new rate once the LIBOR ceases to exist. There have been a lot of banks which have resisted the transition to LIBOR, or the issues that they face with transition to LIBOR, something that I'll cover later in the presentation. And most of them, that's why I prefer to have the mechanism in the document to transition from LIBOR, but do not want to actually agree on a different reference rate on day one. They don't want to agree on the transition reference rate on day one. And so the third bit is where they just agree on the process of renegotiation, or they agree on when the LIBOR would cease for this sort of documentation. And typically it would cease when the administrator of LIBOR ceases to publish LIBOR, or an authority or an authority demands that LIBOR ceases to exist, or the administrator of LIBOR says that it's, or declares that it's gone insolvent. So there are trigger events based on which LIBOR will cease, and on that day or before that day, the parties would sit and renegotiate an alternative rate for LIBOR. Moving on. Something that now that needs to be done, and the purpose for giving these presentations and informing our clients about this is to identify what needs to be done as on today. Like I said, a lot of our transactions are based on USD loans. So you still do have time for that, but that doesn't mean that you don't have to action anything. You have to, there's few actions that we need to take today. First of them being, you have to identify your legacy transactions, which would go beyond 2023 in case of USD, or 2021 in case of all the other are the currency loans. Identify them, identify the maturity dates, see, and if there are transactions which are beyond the maturity dates or beyond the transaction dates, you would have to analyze and either they enter into amendment agreements on day one, wherein you enter into an amendment and agree on a rate switch or a rate switch approach, or agree on an alternate rate today, or the third thing being you agree on how you would renegotiate an alternate rate once the LIBOR ceases to exist. Specifically for syndication transactions, it's very important because any change in any change in interest rates typically require an all lenders consent, but LIBOR transitions, once you have the clauses in there, can be done with majority lender consent. So you need to look at all this. You need to look at your legacy contracts and decide on what you need to do to cover yourself for the change in LIBOR. The second bit is obviously the new transactions. When you are entering into a new transaction, you have to discuss it with the borrowers and decide on what you want to do. Do you want to, again, three approaches there. Decide on a rate switch today, decide on a new RFR, or just have a provision in there for renegotiating of the interest rate. So these are things that you have to do when you're entering into new transactions. What we've seen typically is that for new transactions, because of everyone being aware, a lot of people are taking interest, and new transactions, there's a fair bit of analysis that it goes into when entering into new transactions. But it's the legacy transactions which are being left out, and it's very important that you look at your legacy transactions and decide what you want to do with those transactions. Now, some of the issues that we've seen, and this is something just that we want to leave it with you and for you to consider. Some of the issues that we've seen banks face is that we've seen that the banks have mentioned that moving to an RFR or the calculation methodology of the RFR is very complex. There's certain mechanism that is involved. There's certain complex technology that needs to be implemented by the banks in order to move to RFRs. And that's why we've seen that some banks are resistant on moving to RFRs right now and would want to wait till the LIBOR ceases to exist completely, because of the fact that they do not have either the bandwidth or do not have the technology in place right now to move to an RFR. Then there are a lot of banks which are also considering whether they want to move to the published or the recommended RFRs, which are for USD SOFR or for JBP SONIA, or they want to move back to things like cost of funds, their own cost of funds, or in UK, the Bank of England rate. So these are other considerations that the banks are looking at. There are banks which are looking at not moving to the new RFR, but to a totally different alternative rate. And there are Islamic banks which have issues because for most Islamic transactions, your interest rate needs to be decided before the start of the interest period. Or like for a Muraba transaction, you need to know it before the start of the Muraba period, which cannot happen if you rely on the alternative, RFRs, because those are forward-looking and you would only know them 5 days or 4 days before the interest payment date, which is not how it can work for an Islamic transactions. An alternative that they are looking at is either, again, moving to cost of funds or actually looking at a previous RFR for the previous interest period and applying it to the current interest period. So, for example, your current interest period is from 1st of April to 30th of June. You would actually apply the RFR that's applicable for the interest payment date on 31st of March rather than the actual RFR. And the reason for that is because you need to decide on your interest before the start of the interest period. So these are certain considerations that we've seen in the market, and we've seen banks, having issues with the whole transition in LIBOR. We're happy to hear what other issues you may have, and it's like I said, this is all a learning experience for a lot of us. And like Umar mentioned, we see literally an article every day on this, and there's so many different approaches, there's so many different ideas there, and we just all need to work together to transition properly and to take the best that is applicable for us or is suitable for us. Madhurima?
Thank you, Sakshi.
I would end here and I would now give it to Madhurima to speak on the derivative side.
Thank you, Sakshi. Good afternoon, everyone, and thanks for joining us today. We will now be discussing what happens on the derivative side. When LIBOR cessation was first confirmed way back in 2017, ISDA set up a working group, and the working group considered issues for both legacy transactions as well as new transactions. We will be discussing the conclusions in detail in the next few slides, but in summary, for the legacy transactions, ISDA published the 2020 IBOR fallbacks protocol, as well as certain bilateral forms of amendments and template wording to update the IBOR references. For new transactions, ISDA published the supplement to the 2006 ISDA definitions. We will also be discussing what the protocol doesn't do, in particular in respect of a cash instrument linked hedge or Sharia compliant derivatives, and what the market participants need to consider. We'll also be looking at the impact of the announcement by FCA on derivatives. And finally, just to let you know that ISDA has recently concluded consultation on fallbacks for GBP LIBOR ISwap rate and the USD LIBOR ISwap rate. And based on the responses it has received from market participants, it will now be publishing a supplement to the 2006 ISDA definitions to incorporate the fallbacks as well as some template language, particularly in respect of these swap rates. Moving on, let's go into some detail on the IBOR 2020 IBOR fallbacks protocol. A protocol is a multilateral way of amending trading documents. This is certainly not ISDA's first, and ISDA has come up with many other protocols over the years, though admittedly, this is one of the most popular ones given the complexity and importance of the topic. This protocol was published on 23rd October 2020, and it became effective on 25th January 2021. While certainly LIBOR settings are the first being replaced, ISDA has actually restated the fallbacks for certain other relevant IBORs as well. So it's definitely all the currency settings for LIBOR, but Euribor, Euro-Yen LIBOR, the BBSW for Australia, the CDOR for Canada, the Hong Kong interbank offered rate, as well as the Singapore swap overnight rate and Thailand's THB fix. Excuse me. In particular, the SOR and the THB fix is more crucial than the others because these are synthetic rates, which is partly based on the USD LIBOR. So when the USD LIBOR ceases to exist, these rates are more affected than certain other rates. Excuse me. Going into protocol covered documents. What exactly are the protocol covered documents for this particular protocol? Of course, ISDA's agreement, that's the 92 and the 2002 forms, are protocol covered documents, as well as the various credit support documents and trade confirmations. But given market view and the complexity and importance of the topic, ISDA has included certain other additional master documents in the scope of the protocol covered documents, and which are most importantly, from the region's perspective, the GMRA and the GMSLA. But crucially, it excludes the ISDA Tahawud agreement. We will discuss this in a little bit more detail in the next few slides. Now, how exactly are legacy contracts amended? So what is amended is a protocol covered document that incorporates either a covered ISDA definitions booklet or references to a relevant IBOR. Of course, ISDA the main definitions that are being updated under the covered ISDA definition booklets is the 2006 ISDA definitions. It has been the single most important set of definitions in the last 15 years, but There have been other older definitions, and there are long-dated legacy trades which are still outstanding on those definitions. So ISDA has taken this opportunity to update the 2000 ISDA definitions, the 98 ISDA Euro definitions, the 91 ISDA definitions, and the 98 supplement to that, all at the same time in respect of their relevant IBORs. Now, coming to the adherence process, it is, as I said, a very popular protocol. And if you've not already adhered, adherence can be done directly on ISDA's website. There's a one-time cost of $500. Currently, there is no cut-off date. And as you can see, it already has more than 14,000 adherents. So if you have not adhered, there is still time, and we would recommend you adhere as soon as possible. And given the number of adherents that it already has, very likely most of your counterparties have already done it. Now, timing. When are the actual amendments to the legacy contracts valid from? So as I stated previously, 25th January was the effective date of the protocol. So if both parties had adhered to the protocol prior to 25th of January, the amendments to the legacy contracts are valid between those two parties from the effective date of 25th January. But that may not be the case. Either or both parties may have adhered to the protocol after the effective date, in which case it is the later of the date the two parties adhered when the amendments to the legacy contracts between those two parties come into effect. So as an example, one party adhered on the 1st of March 2021 and another party on the 1st of July 2021. So between those two parties, the amendments come into force on 1st of July 2021. Now, other than the protocol, ISDA also published certain bilateral forms of amendments and template language in respect of IBOR fallbacks protocol. Forms of bilateral amendment which are published by ISDA. Two forms are there to adopt the protocol if either one party or both parties don't adhere to the protocol, but actually have affected legacy transactions between them. And the third is for parties who have adhered to the protocol. And all of these three forms are available in both the principal and agency versions. The first form of amendment is the short form amendment. It incorporates the ISDA IBOR fallbacks protocol by reference, and effectively it has the same effect as both parties adhering to the protocol itself. ISDA also adopted, or rather published, the long form amendment to the protocol. It incorporates the text of ISDA's IBOR fallbacks protocol in totality. It allows for flexibility so that if you have any amendments to the text of the ISDA IBOR fallbacks protocol, you can do it. It's very easy to do it. But if you're not going to make any changes, it's just easier to use the short form amendment because it has the same effect. And the last form, as I said before, it's for parties who've already adhered to the ISDA fallbacks protocol, but it actually has certain identified master agreements, credit support documents, or confirmations where these changes are not required or not relevant or should not be made. So if you, through this form of amendment, you can actually reverse the changes made. So it's not that the changes were not made because of the protocol when both parties adhered to the protocol, but these changes are now being reversed through the amendment and solely in respect of the named master agreement, credit support documents, or the confirmations. ISDA not only published the bilateral forms of amendment, but it also had published certain supplemental template wording for particular situations. These can be added to these other bilateral amendments as we just discussed, or any other form of amendment that you may want. But these are not template amendment form by themselves, which means that you can't just take this language and get this signed. You actually need to put it in the form of an amendment. And the template wording covers various situations. The key one is to exclude certain protocol covered documents. from the purview of the IBOR fallbacks protocol for various reasons. It could be that the triggers and fallbacks have to match hedged cash instruments, maybe a bond or a loan, or on the basis that the documents include negotiated fallbacks, or it provide for triggers and fallbacks identified in a separate document. But for whatever reason it is, it's just that these documents need to be excluded. Certain documents have to be excluded from the IBOR fallbacks protocol. Or it is also published language to apply the terms of the protocol where to new agreements which do not actually incorporate the ISDA definitions or any particular relevant IBOR, or to disapply the pre-cessation trigger, which is hardwired into the IBOR fallbacks protocol. Now, let's take a minute to talk about the pre-cessation trigger. So the way the fallbacks protocol is drafted, it means that the triggers and fallbacks for any particular LIBOR rate becomes effective immediately if FCA, a regulator or a supervisor of IBOR states that the LIBOR is no longer representative of the underlying market. What this means is the LIBOR rates are still available, but a pre-cessation trigger has occurred, because of which the LIBOR rates are now moving to the risk-free rates. And this is hardwired into the fallbacks protocol. Now, the parties may not actually want that. The parties might still want to use LIBOR till the time it is available, in which case you can apply this template wording into your documents. Now, coming to the supplement to the 2006 ISDA definitions, which was also published at the same time. This particular supplement is the 70th supplement to the 2006 ISDA definitions. Supplement is a very easy way of updating certain parts of the ISDA definitions as and when required. And as you can see, this is a very common way that ISDA makes changes. This is the 70th supplement, so there have been 69 before that, and a few after that as well. The 70th supplement amends and restates the fallbacks for the relevant IBORs, and it applies to all new transactions entered into after 25th of January 2021 that incorporates the 2006 ISDA definitions, or all legacy transactions which incorporates the 2006 ISDA definitions, and both parties have either adhered to or bilaterally adopted the ISDA fallbacks protocol. The way the fallbacks are restated is now there is a fallback waterfall, so successive fallbacks for each rate. So there's a primary fallback upon the cessation event or a pre-cessation event, where there's a move from the LIBOR or the relevant IBOR to a risk-free rate plus the spread. But there is also the scope of a further fallback when the first fallback rates are discontinued. This is a way for ISDA and market participants to make these definitions more future-proof, for the want of a better word. Now, let's consider the impact of FCA's announcement on the derivatives world. So the announcement itself was an indexation event in respect of all LIBOR rates in whichever currency. The FCA at that time had said that they don't expect LIBOR to become unrepresentative of the market before cessation. So a pre-cessation announcement is not expected. Which means that a pre-cessation trigger is also not expected with respect to LIBOR. The index cessation date will be the 1st of January 2022 and 1st of July 2023 as applicable, depending on the tenor and the currency. And the spreads, the credit adjustment spreads, were fixed as of the 5th of March 2021, which I'm sure all of you know is the historical difference between the IBOR and the compounded RFR over a 5-year period before the trigger event. Now, we've spoken about the protocol and the supplement, but what does the protocol not do? So the protocol is very easy to update where you have references to LIBOR, but it doesn't take into consideration when you have cash instrument linked swaps, particularly those linked to bonds or a syndicated loan. In those cases, the borrower and the hedged counterparties may have hedged a cash instrument and have contractual obligations to follow another rate, that is the rate that comes from the bond or the loan, or may just commercially want to do that. So this is not something that is addressed through the protocol, and the parties will have to engage bilaterally to come to a conclusion. Another point that is relevant for regional institution is a back-to-back hedge. Many institutions don't actually keep the risk on their books and may have hedged it out to another counterparty. What can happen is your primary hedge with your borrower moves in the direction of the loan or the swap, and which may not be where the protocol is going. So your back-to-back hedge may actually have a mismatch, or there may be a basis risk. So these need to be looked into and identified and accurately addressed. The other big point that is not addressed with the protocol, of course, is the Sharia compliant derivatives. As we discussed before, the ISDA Tahawut is excluded from the ISDA IBOR fallbacks protocol. But taking a step back, ISDA's Tahawut, or the credit support deed, or the templates of various undertakings, do not actually include references to an IBOR. But in practice, most of the time when the undertakings are signed, they either refer to a relevant IBOR or to the ISDA definitions. And these do need to be updated on a case-by-case basis, in particular keeping in mind the structure, which is not easy to do when you directly think of the change between a forward-looking rate like LIBOR to a backward-looking RFR. IIFM has taken an initiative and has actually published a white paper which talks about the feasibility of a protocol for Sharia compliant derivatives. And their conclusion is it's very difficult to have because there is no one size fits all approach for Sharia compliant derivatives. But they are working on fallback clauses and RFR related amendments, and we expect some recommendations from them, though no timing is indicated as far as we are aware. Now, to bring this all together, we have discussed the protocol, the bilateral forms, the supplement, as well as what is not covered in the protocol. But as market participants in the region, what is it that you need to do? And the first step, of course, is due diligence. Your legacy transactions cannot be ignored, and gap analysis is the first step. You should be looking at the documents for all of your transactions, but also the commercials. Is it linked to a cash instrument? Is it a back-to-back hedge? Or is there anything else that you need to think about on the commercials? You should be checking whether your counterparties have signed up to the ISDA protocol, and to the extent they have, you might want to think whether any carve-outs are necessary. And for that, you have to enter into a relevant bilateral amendment. And where your counterparties have not signed up to the protocol, you will need to enter into relevant bilateral amendment for any changes. You should also be identifying all of your Sharia compliant derivative documents, and to see where you are, what needs to change, so that you are at the ready when IIFM comes out with its recommendations. For new transactions in particular, think about including the 2006 ISDA definitions in all of your transactions, as well as the 2021 transactions. As you're aware, ISDA has just published the 2021 transactions, and they come into effect later on in the year. So once that comes into effect, you should be incorporating the 2021 definitions. For cash instrument linked new swaps, you should be updating the confirmation to ensure that the loan and the hedge is matched. And finally, on Sharia compliant trades, consider engaging with other market participants as well as the Sharia board to think about template language even before the IIFM comes out with its recommendations, though there should be some announcements from them in the not too distant future. In particular, if you're an Islamic bank trying to deal with US, UK institutions, they may not be able to deal with you at this stage without agreeing a full fallback. So to that extent, you do need to engage with your Sharia board to see whether there is a halfway path that you can meet in this respect. This is all from us on the derivative side. We will continue to monitor this and provide an update as soon as we know something. Moving on, questions?
Yep. Thank you, Rima and Madarima and Sakshi. That pretty much concludes the prepared portion of the presentations. We're up for questions. I don't see any currently, which doesn't surprise me because I knew that Sakshi and Madarima were going to do such a fantastic job that they would have answered all the questions in the course of their presentations. But if you do have any questions, now is a good time to ask them. We do have some time, so there is a button at the bottom of your Zoom platform where you should be able to submit any questions that you may have. As you can glean from the presentations, there are a number of moving parts and things are happening at a rapid rate. Some of our bank clients and financial institutions are well ahead and have been kind of sifting through the issues, and some are just getting started. So, you know, we are here, obviously, at El Tamimi & Company to assist in any way we can. Sakshi and Madarima, as well as many others in our banking and finance group, have been busy throughout the year, really helping our clients out with the issues involved with the transition. So feel free at any point to contact myself or Madarima or Sakshi or any other member, really, of the El Tamimi Banking and Finance Group to assist. I still don't see any questions, so I'm going to assume that everybody has gotten what they needed out of the presentation. I will say this, that to the extent that you do have a question at a later time, sometimes these things pop into your head once the presentations are over. Please don't hesitate to reach out to myself or Rima or Sakshi with your question, and we will most definitely get back to you as soon as possible with a response. If I don't see any other questions, so I'm going to end it here. And like I said, I really appreciate all of you joining today. I know you all have busy schedules, and we look forward to hearing from you in the future. Thank you so much.